We all love that dividend cash flow, but are you buying the wrong dividend ETFs for your goals? Hey Bowtie Nation, Joseph Hogue here, ranking the 7 most popular dividend ETFs and, more importantly, showing you which is right for your goals. I'll rank each of these dividend funds from the Schwab SCHD to the Dividend Aristocrats and 2 Vanguard ETFs by risk, return, and how much money they put in your pocket. But I'll also highlight who should buy each and which should be avoided at all costs. First up is the popular NASDAQ 100 Covered Call ETF, ticker QYLD, with its high 12.5% dividend yield. But you see immediately why it's at the bottom of the list here. That 22% loss on the price over the last 5 years means after accounting for that, investors have only made an average 7.6% return a year. Looking at the stocks in the fund, it's a who's who of big tech companies, with more than $500 million in shares of Apple alone, along with Amazon and Microsoft. But if you scroll down, you see it's not all of its tech stocks. You've also got shares of Comcast and Pepsi as well, because they're in that NASDAQ 100 index. Now, what you don't see here in the top 10, you can see in the fund holdings on its website, is the covered call strategy. So what it's selling to offset some of the risks and generate cash. So digging further into that, we see that the fund has sold call options expiring February 21st on the NASDAQ 100, the index of stocks it's holding. Selling those call options has brought in just over $198 million, from which the fund can pay those monthly dividend yields. So the ETF holds those shares of stock in that NASDAQ index, then sells those call options against them. That covered call option strategy helps the fund do 2 things here. First, by collecting a premium selling those call options to another investor, the fund generates the cash flow. In this case, most of those tech stocks don't pay dividends anyway, so it's a great way to turn a portfolio of tech stocks into an income-producing investment. The strategy does something else, though. It also gives the fund exposure to those high-return NASDAQ stocks, the fast-growing tech stocks in the market, but lowers the risk a little. You see, by selling those call options, the other investor is taking some of that risk that the stock prices fall. So the fund not only generates that cash, but will also be less volatile than just owning the NASDAQ 100 tech stocks outright. Now, of course, the downside to this strategy is because the fund is selling to another investor the right to buy the shares at a set price, the ETF misses out on some of that upside return when tech stocks boom higher, but we still see a loss when the stocks fall. Now, the QYLD may be the worst total return and price return of these 7 dividend ETFs, but that doesn't make it the worst dividend fund for you. It's an important point that we're going to talk more about later, but if your goal is that dividend fund that pays your bills, this one does pay the highest yield of the group at 12.5%, so maybe if you're not worried about that long-term portfolio value dropping, then this is still one to watch. Next up is another very popular ETF with $11.7 billion in assets, the S&P 500 Dividend Aristocrats, ticker NOBL, with its 2% yield and 7.9% total annual return. Now, the Dividend Aristocrats are the stocks in the S&P 500 index that not only pay a dividend, but have increased their dividend payouts for at least 25 consecutive years. That NOBL fund adjusts each year, adding any new stocks that make the list and dropping those that couldn't make the cut. And it's got some great companies here like Clorox, Walmart, and Kimberly-Clark. The group pays a 2% dividend yield, which might not seem that great, but is 53% higher than just the broader market average dividend yield, with a solid price appreciation and is surprisingly well diversified across sectors. You can see in the chart here, it's a little heavily weighted to consumer staples and industrials, but then has a solid mix in the other sectors of the economy as well. Despite that lower yield and only about an 8% annual return, I think this one could be a good ETF for a specific goal, even though we've still got 5 other funds that beat it on yield and growth. That strategy of investing in companies with 25 plus years of dividend growth means you're getting the most stable, cash-flowing companies. Companies that are going to be around well after you and me have transferred our accounts into Cloud9. That is a dividend you can always count on, even if the growth isn't anything special. We've still got 5 of our best dividend ETFs on the list, but another way I've been getting that cash flow is through the Arrived Homes platform. The platform packages rental real estate as LLCs, so you're getting a direct investment for less than $100, and without the massive down payment or management headaches you get from rentals. You earn a dividend on that rental income, and Arrived has recently transitioned to a monthly dividend payment, so you're earning from 3 to 8% annualized and getting that cash flow every single month, along with the price appreciation when the property is sold. This is one of my favorite investments right now, but I know you've got a lot of questions. I know I did, so I'm going to link in the description to the platform. One thing, the homes available for investment sell out fast, so make sure you click through and get on the notification list. The largest dividend ETF out there with $103 billion in investor assets is the Vanguard Dividend Appreciation Fund, the VIG, with its 1.7% dividend. And Frankly, I'm only including it here because so many investors are holding the fund and are wondering where the hell their dividend has gone. A lot of the problem here is dividend stocks have just outrun their payments, causing those yields to plunge. You could have bought the Vanguard VIG last year at $152 a share, and the fund had paid a dividend of $3.16. Now that means the yield, the dividend divided by price, was a more respectable 2%. But after that 31% jump in the price of the stock, even an 8% jump in the dividend amount just can't save that yield. So at just a 1.7% yield, you've got to be asking yourself, is this still even a dividend fund? Because it's not in my book. The total return beats those earlier two dividend funds, but dividend investors want to see that cash flow, and it's just not here. Worse still though, and something most investors won't know until it's too late, I dug deeper into the fundamentals of the Vanguard ETF here and found a dividend fund on the edge. Companies in the fund are growing earnings by just 4.7% on less than 6% sales growth. Now that is a huge problem if you think about it. A company only growing its profits by 4.7% can't very well be increasing its dividend by much more than that. It means the 10% dividend growth investors have seen in the fund is probably unsustainable. And again, this is probably the worst fund on the list because it's not really fulfilling any investor goals here. The yield is too low. There are other ETFs here that are better for safety and others that are going to grow your portfolio faster. Now, Vanguard does have a good alternative here through the High Dividend Yield ETF, the VYM, with its higher 2.7% yield and 9.5% total annual return over the last 5 years. This one also invests in very large U.S. companies, holding shares of 450 stocks with a median market cap of $132 billion. So the focus here is on that higher yield. There isn't much tech or growth here, with just 11% of the portfolio in tech stocks. You've got older tech like Broadcom and Cisco, but it's mostly those other sectors, dividend payers like JP Morgan, Exxon, J&J, Home Depot, and more. And here, you're still not setting the world on fire with that dividend yield, but it's nearly double the yield on the VIG, and the price return was almost exactly the same over the last 5 years, so that total return is higher. Now, all you out there in the nation know 3% dividend yield is pretty much my cutoff for what I consider a true dividend stock. This one doesn't quite make that, but could still be a good choice for those investors out there that like to see their dividends hit the account, but where portfolio growth is still a little bit more of an important factor. We've still got 3 of the best dividend ETFs left, the best for income investors and the best for portfolio growth. But nation, if you get one thing from this video, understand that you need to fit your stocks to your goals and your needs. Now I'm ranking these ETFs on total annualized return, so the combination of their price return plus the yield, but that might not be what's important to you. Investing just on total return may totally miss what you need in an investment, and that is why you need to consider how the fund is producing that return, what stocks is it holding, and how those fit your goals, along with whether you need that income now to pay the bills, or would rather to see your portfolio grow for the future. This works with any ETF. Before you buy, not only look at that dividend yield and the price return over the last 5 years, but also visit the fund's website, look for its holdings or portfolio here in the menu, and then look at those individual stocks it's holding in the fund. Back to our list, and the JP Morgan Equity Premium Income ETF, the JEPI, has been one of my favorites with its 7.3% dividend. Researching for the video though, I was a little surprised that it's only produced a 17% return over those 5 years, so about a 10.5% annualized return. That means there's 2 other funds that beat it for growth. The fund invests in defensive, large cap stocks like insurers, consumer staples, and pharmaceuticals. You see here, it's all those big bellwether stocks like AbbVie, Coca-Cola, and United Health. That's going to give it some safety when the market tumbles. And then the portfolio managers sell those call options on the S&P 500, that broad stock market index, to generate those cash flows for dividends. That gives it a similar strategy to the one used by the QYLD. Here we see it's a $55 million position against the portfolio in sold call options or other instruments to produce that 7% dividend yield. So here I think the JEPI can be a good choice for those that want that higher dividend yield, like the QYLD, but don't want to see their portfolio shrink with the falling price. The downsides here are that it's not strictly a monthly dividend, though it does pay more than quarterly, but it's also not qualified dividends, so the money you collect is going to be added to your income and taxed. The Schwab US Dividend Equity ETF, ticker SCHD, has always been one of my favorites with a solid 3.6% dividend, but got edged out in this on its list with its lower 10.9% total annual return. Now we're going to see here that there might be an asterisk here, a catch with the next ETF, so this one could be the top on your list. Besides that total return, I love the SCHD for its simplicity. It's not using any complex option strategies, just investing in the best dividend-paying companies, holding 100 stocks of quality cash-flowing companies like Broadcom, AbbVie, Chevron, and Coca-Cola. And while the fund only pays a 3.6% dividend yield, and you have to wait those 3 months to see each quarterly payment, the share price has grown consistently to produce that 10.9% total annual return. And then another upside to the SCHD is that it pays qualified dividends, a major benefit that we haven't covered that's going to save you thousands of dollars in taxes. You see, folks, not all dividends are created equal for taxes, and it could cost you thousands of dollars. In fact, the highest yielding dividend ETFs in the list are going to be taxed at higher rates, meaning Uncle Sam is going to take a bigger chunk of your dividends. You see, in the US, dividends are taxed in one of two ways, either as ordinary dividends or as qualified dividends. While qualified dividends are taxed at either 0, 15%, or 20% depending on your income, any amount you collect in ordinary dividends each year is going to be added to your regular income and taxed at those higher income tax rates. You can see the difference this makes in those rates here. And importantly here, some of those income strategies like the covered call options ones and the dividend ETFs don't qualify for that lower tax rate no matter how long you hold them. Any dividend ETF selling those options to create that dividend income, like the QYLD, all that dividend is going to be taxed at that higher income tax rate. Think about it this way, that 12.5% dividend on the QYLD looks great, but if you're in the 33% income tax bracket, then it's really only an 8.4% yield because you're paying that higher tax rate rather than the 15% you could be paying on a qualified dividend in another fund. So understanding if your dividend stock or ETF pays that qualified dividend is going to take a little bit more research before you buy. Many of the real estate investment trusts or REITs, master limited partnerships, MLPs, and income ETFs do not qualify for this, so always check on the ETF's website. You still might want some of those higher yields on those non-qualified dividends, but understand you're probably not getting as high a yield as you think. I'm going to reveal the top dividend ETF next, one with a 16% annualized return and a high yield. But nation, man does not live on dividends alone. While some of these dividend ETFs will slowly grow your portfolio, none are going to do it like the 10 ETFs I highlighted in this video, the best ETFs to buy right now. One of these ETFs, in fact, would have doubled your money in the last year alone, so make sure you check that out next. Best dividend ETF, the JP Morgan Nasdaq Equity Premium ETF, the JEPQ, is a twist on the JEPI with a higher 9.7% dividend and a 16.6% annualized total return. The JEPQ holds those stocks in the Nasdaq 100 index, the tech-heavy group of stocks, and then sells those call options against them to create that income. That focus on tech stocks in the JEPQ rather than the defensive names in the JEPI helps it outperform in a bull market, though it could fall a little further in a recession. Similar to the QYLD with its focus on the Nasdaq 100 index, but with the expertise of JP Morgan managers we see in the JEPI, this one has produced a 15% annualized return over the fund's life. Now, I did tell you here there could be an asterisk, and it's that the fund has only been around for 2.5 years, so this isn't a 5-year return like we saw with the others. So that higher annualized price return may look more like the JEPI over that long term, but the focus on faster growing tech stocks means it could still beat on growth. Overall, it's just a very solid return, and it's hard to beat combining with that nearly 10% dividend plus the growth focus. Get your dividends monthly and invest in rental real estate with the Arrived Homes platform and the invite link in the description below. Or click on the video to the right to see those 10 best ETFs to buy right now. Don't forget to join the Let's Talk Money community by tapping that subscribe button and clicking the bell notification.